Hello, everyone. Well, thank you for joining me today. I'm streaming live on Twitter, also streaming live on YouTube, and streaming on Twitter Spaces. It's kind of a little bit of a spontaneous um, presentation today, but yeah, doing like a little bit of a due diligence on MEG Energy. I think there could be a lot of value from that. I hear a lot on on Twitter about doing due diligence, do your own due diligence, stuff like this. Well, I actually kind of do my own due diligence, so I wanted to share kind of a little bit more how I approach this and how what the kind of things I'm looking at, and hopefully you guys get a lot of value from that. I'm not a financial advisor. Everything you hear from the space or this live is my observation from what I see. I will not provide any recommendations, but yeah, hopefully you guys like this the space, and hopefully you like the live and the slides, and we can kind of go from there. So before I proceed, I wanted to okay. So one second, I just want to check that I'm live everywhere. So which is good. Yeah, looks good. Thank you. Um, I wanted to share a little bit about what people are saying in in not social media, but on BNN Bloomberg and such about this company. Just as a disclosure, I'm not a shareholder in this company, so there is no conflict of interest. But I hope to share some valuable information here today. So basically, on when it comes to MEG Energy, is a Canadian oil sand producer. And we had several guests on being in Bloomberg lately talking about the company. And one of them was Eric Nadel, the other one was Andrew Pyle. So, Andrew Pyle on March 7th, I think, he had mentioned that it's a small cap energy name, that it outperformed the bigger peers. He said great performance, but he remains bullish on oil, and the shares are ahead of its skis. That's kind of what he said, and he had mentioned to take some profits. At the same time, we had Eric Nadel, a 9 Point fund, talking about this company, and he had mentioned that it's his largest holding in the fund and continues to be a shareholder. It's highly leveraged to the price of oil, which makes sense, being the Canadian oil sands producer, and he is expecting 100% gain in the price in the share of in the price of the shares. Premium quality asset, but soon enough we will see from the slides whether that's true. And he said that the company is planning on returning 100% of the free cash flow or the cash flow to shareholders, and by the end of the year. And he continues to hold shares. So this is like a little bit of a I guess disclosure of what others are saying about this company. And yeah, so before we proceed, let's take a look at before we look at their presentation, and before we look. So a couple of things I want to do here. I want to look at the corporate presentation. By the way, I'm streaming again on YouTube Live and Twitter Live, so you can see the video if you want to. But I hear sometimes the battery is being drained really fast if I stream on Twitter, so you can always watch it on YouTube later and maybe do like adjust the speed if you want. But I will be looking at their corporate presentation and report to shareholders of 2022, and kind of doing due diligence that way. Really looking at the financials, what they're communicating, and where they're going forward. Again, as a disclosure, I'm not a shareholder. There's no conflict of interest here, and just want to basically, do some due diligence on the company, decide if to invest going forward, and really maybe for educative purposes, share it with the community on how I approach my own due diligence. And I'm not a financial advisor. So before you kind of, as we watch, let's talk a little bit about what kind of technology is being utilized. For that purpose, I'm sharing right now on Twitter Spaces and Twitter Live. So one second. Oh, all right. Let's see. So let's present, share screen, window. Okay, so right now you should see a video on YouTube. This is an old video from Synovus, and it speaks about understanding the SECD process. So I'll quickly play it, and you will see kind of, I'll post a link on that as well, but you can see where the assets for bitumen extraction are located. They're located in Alberta, northern Alberta there, and you can see on the map what's being disclosed. So then you have this enhanced oil zone where, when it comes to kind of the McMurray oil sands and mineable area, which is at the surface, but then you have this in situ area at the bottom. And so you can see the rig and kind of how it will drill that. So then you go basically vertical and then you land lateral, right? So you'll have basically two well pairs, and I'll pause it here. So you can see you have injector, you have a producer there, and you kind of land in that McMurray sand zone. So it's almost like a tuxedo cake, and then you have the cup rock and various levels of other geologies, but that's where kind of the oil sand sits. It's literally like sand with saturated oil and water, right? So it has some clays and some other geologies. But the reason why I'm talking about this is because MEG Energy utilizing this technology, it's called SECD, to produce their asset. So let's play it a little bit further. So right now what you see is steam being injected. There's a significant amount of heat transfer to the reservoir. And there's the steam chamber development, right? And so they have many of those well pairs that kind of do that. And a cluster of those well pairs, it's called a pad. So they basically inject that steam and they produce the water back and the oil that's being produced. So as you can see, there's this really nice chamber development that's taking place. So, and then they produce the emulsion to surface, and they treat it and basically recycle the water and re-inject it back, generate more steam, and put it back in the system. So that's kind of how the operational strategy works for them. And so everything is being kind of treated to the surface, as you can see in that video. Okay, so right now I'll share. I'll share another screen. So thanks for watching that. Let's share their slides for corporate presentation and kind of go over that. All right. Corporate presentation shares. Oh, and before I share that, I will make a disclosure. So I'm right now on YouTube Live, Twitter Live, showing some videos, showing some slides, but also on Twitter Spaces Live. Before we proceed, I wanted to tell you, before we proceed to the corporate presentation, I shared this in the past. I have this book I wrote. It's called Apollo Autism. I sell it on Amazon. I basically donated all proceeds from it. So, and what it does, it helps, it helps people to become a little bit more patient and kind of advance happiness in families. So Apollo Autism sells right now on Amazon. So if you guys want to support me, please purchase that book. So thank you so much. And at the back, you can see kind of my picture and some description about who I am and what I do. And yeah, I'm really proud of that book. I think it was a nice achievement for me. So let's share the corporate presentation for MEG Energy right now. All right. So as we look at the corporate presentation, so this is kind of the concept of due diligence, right? You really want to look at what they're presenting, what they're guiding, the financial. We will look soon at the financial reportings, but really understand kind of what they're telling the investors and kind of going forward, what's going on here. So here they say why MEG Energy, and maybe I'll zoom in so people can see it a little bit better and kind of go over those numbers. So they say 1.94 billion barrels of 2P reserves, greater than 50 years reserve life index, and they have this little disclosure here that this is based on production of 103,000 barrels per day. So basically, that 1.94 billion barrels of 2P reserves, you can produce it, so greater than 50 years, assuming you produce it at rate, right? So 103,000 barrels per day. They also say low production decline profile. 15%, and associated low sustaining capital equals greater free cash flow. So that's great. Second, lowest steam to oil ratio, SOR in the sector, 15% below peer average. And so when I was showing that video that I streamed on YouTube and Twitter, you can see that it really benefits you economically, also from an environmental perspective, if you have low SOR, right? So they're very proud of that here. So they say our steam to oil ratio is the second lowest in the industry. So that's pretty good. Excellent capital efficiencies in both short cycle recompletions and long cycle new pads opportunities. So what they're basically promoting here is that they're saying, well, if we just have to redrill a well or maybe recomplete a well, we're very efficient when it comes to the capital, but also in the long cycle new pad development. So to deal with that 15% decline rate profile. Now that could be a function of maturity of their pads as well. So that's kind of how they're looking at, basically, hey, we have low essentially excellent capital efficiency. So that's what they're very proud of. And the category here that they promote is high quality asset base. And then they tell you basically, hey, we have high life index in reserves, right? 50 years. We have low production decline profile. We have the lowest SOR in the industry, and we have very good kind of capex OPEX structure. So that's really great. On the free cash flow generation, unhedged pure play. So it's really important to kind of keep in mind unhedged pure play, and that structure is kind of interesting going through that cycle right now. And they're applying the 100% of the free cash flow to debt reduction and share buybacks. So that's really interesting, that guidance, because they're saying, look, we're going to apply like 100% of free cash flow to debt reduction and share buyback. So that's good to know, because and soon in the slides we will see how they have that structure, because they've been pretty good at paying down debt, and now they're going to be, they've been buying back shares, so they have like this percentage of how they've been allocating that. Okay, so we have a couple of comments here, so I want to make sure. Yeah. All right, looking good. All right, so 15% estimated 2023 free cash flow yield at 80 WTI. Well, and guess what? We're at 80 WTI right now, and they're saying for free cash flow yield for 2023, if we take 80 WTI, we're yielding 15%. So they're basically telling you that. And not expected to be cash taxable until 2028 at $80 WTI. So they're going to start paying taxes, I guess, 2028. So not in the next 5 years, which is kind of cool. So we're going to be seeing a slide on that. Free cash flow split equally between net debt reduction and share buyback. So here they're telling you how they're going to be allocating this free cash flow. 400 million of share buyback since March 2022. That's cool. 1 billion, about 1 billion US of debt repayments at start of 2022. So significant debt reduction. And I think that's why sometimes we see this deviation between oil prices and between oil prices and the companies and how they perform. And I think it speaks kind of to that debt repayment levels, which really benefited them. So 100% allocation to shareholder returns when net debt reaches 600 million. So that's pretty cool. I think MEG is like really proud of their market access. So let's see what that's all about. They're saying tidewater access enhancement, bitumen realization, 80% of 120,000 barrels per day blend sales is firm service pipeline access to tidewater. Okay. Contracted dock space for 500,000 barrels per month of U.S. Gulf Coast, export capacity to Asian markets, and over 2 million barrels of strategic storage, which provides operating and marketing flexibility. And then they make some comments about ESG. So zero fresh water utilized, greater than 99.5% maintained conservation, and targeting 0.63 megatons per annum reduction in absolute emissions. So that's pretty good. Okay, so let's see more about kind of the company here. Again, disclosure, like I'm not a financial advisor, so just doing due diligence here. trying to better understand MEG Energy, looking at their balance sheet, looking at their presentation, right, and just sharing this with the community. So maybe you don't have to, and maybe you can take kind of the next step and better understand if there are certain things that you want to look at. But basically, they're at 6.4 based on the slide at market cap. Net debt about a billion, I think now. So this presentation is from March, I think 2023. So they probably paid down a little bit more debt. Enterprise value 7.7 Canadian, and this is the number of fully diluted shares, 293 million shares. And you can see when they said about the SOR that they're the second lowest in the sector. I guess that's kind of what they're showing there, 2.36 meg, and there's other peers there. So when it comes to bitumen production, you can see here they had fairly significant uplift lately in oil produced. So that's kind of nice to see, and you can see kind of their profile. 2020, it seems like there was a response to cutting production because of COVID. But you can see kind of over time in 2017, 2018, 2019, they were kind of ramping up production. And I think they've kind of been adding maybe pads. 2022 was a big impact. I think what's really interesting here is that 2017, 2018, 2019 was a time of kind of a downturn in the sector. And despite that, they've been kind of growing production. So, which maybe speaks to their ability to, to generate cash at the lower price environment, which is what we saw in 2017, 2018. And 2021, 2022, obviously, kind of flashed the 2022 production, going 21, 22, and 2023, obviously above 100,000 barrels per day, which is kind of cool. For those of you joining on Twitter Spaces, I'm streaming live on YouTube and also on Twitter, so you can kind of see the slides of what I'm talking about. And today I'm doing due diligence on MEG, just ensuring my kind of work with the community. So currently reviewing the corporate presentation, and soon we'll do some financials to kind of better understand where they're going. So increased cash flow to debt reduction. So they generated 1.5 million Canadian, 1.5 billion Canadian of free cash flow in 2022, which drove 870 million US reduction in net debt to 1 billion. So to 1 billion US, and that's the 1.2, 1.3 billion Canadian in debt. So that's good, right? Because I think market cap was like 6.5, 6.6. So a billion in debt, so you kind of can get the ratio. And they basically told us how they're going to be allocating the free cash flow. So we can look at that. In operational excellence record, 111,000 barrels per day production in Q4. It's very noticeable when you look at the financials. So we'll be taking a look at that as well, with focus at the SOR at 2.2. The SOR 2.2 is basically 2 barrels of steam being injected to produce 1 barrel of oil. All right, so what are they saying for 2023 outlook? Let's take a look. So for 2023, their guidance is capital expenditures, $450 million. So it gives you kind of good reference because kind of relative kind of value of the company to what they're going to be spending. So in my mind, it's pretty good. Average production 100,000 to 105,000 barrels per day. You can see the significant low OPEX from the operation. So $4.75 to $5.05 per barrel. And, we just saw basically a jump in WTI of $5 because of OPEC announcement. And here you have a $5 non-energy OPEX. When it comes to G&A, it's $1.70 to $1.90, which is extremely low. So again, like any price movement in any direction here provides significant, torque to those names. And you can see how they're going to be allocating this capital in the slide. So the capital budget, the 450 million they're talking about in 2023. So the biggest portion, which is 235 million, right? It's going to be like, so what is that all about? So that's going to be well pad redevelopment and facility and field infrastructure. 55 million going to be spent on turnaround. So that tells us there'll be some kind of turnaround in 2023, but maybe a smaller one because I think much more money was spent last year. So maybe like they have another phase where they're going to be like doing some shut-in production, and maybe that's why they're yielding 100 to 105, but they produce 111 in the last quarter. So maybe there will be like a small impact on the production as well. So basically what it says here is that the 2023 capital combines optimized well spacing. So that kind of tells you maybe how they achieved the low SOR, right? So optimized well spacing. So when I was showing that video, how they have the well pairs, maybe they have like an optimized well spacing between those well pairs. Enhanced completion designs. Enhanced completion designs tells me maybe they have like cool design for their injector producer completion that optimizes their steam injection. And then they say capital efficient redevelopment to maintain production. So maybe like low cost development for new pads and redevelopment kind of allocating that steam as they go forward to maintain production. So basically, you're not seeing significant decline, but just sustaining production is something they've been doing for the longest time. So 50% allocated towards new pads. So they're telling you they're going to be developing new pads, and huge portion of about 50%, over 50% of that. Yeah, so over 50% of that capital is going to be allocated towards new pads, gathering system, and short cycle production. 20% directed towards facility and field infrastructure, and 50% turnaround and others. So we kind of covered that in detail, I think. So that's looking good. All right. So annual debt reduction. So you can see in 2016, they had like significant amount of debt, right? So and then over time they've been kind of reducing the debt, and by now they got the target debt is $600 million here. That's what it seems like. Net debt target $600 million US. But look where they came down from based on the slide. That's fascinating, right? So they were 2016. So from 2017 at $3.6 billion US net debt, and they were cutting that significantly. Like 2020, you can see there was barely any cut. And then towards 2022, significant cut, going from over 1.8 billion to just under 1.2 billion. So that's really impressive, and that's kind of tells you their ability to cut debt and achieve that $600 million net debt target. Now, what's really cool about this, they give you some trajectories here. So they say, okay, well, if WTI is going to be $60 US, then we're going to be basically at the debt target, which is indicated here. So it's roughly $1 billion, right? So $1 billion. So basically they're saying, based on this slide, what it tells me is that this is probably their break even, right? Because if you committed to paying down debt and buying back shares, you're at $60 US WTI, and I think with $15 differential, that's $45 WCS. So that tells me that's kind of maybe the break-even part. So I think like, and that's kind of part of my due diligence, right? That's kind of what I do sometimes. So every quarter I'm going to go over those companies and really try to understand what's the structure. And that's why sometimes when you hear me talk about this, that's kind of how I see it, right? Because there's like hidden gems of communication within the different slides. By the way, for those that join on Twitter Spaces, I'm streaming live on YouTube and Twitter, so you can see the slides and what I'm talking about, and all of that will be recorded, so you can kind of do a double speed and take a look. Now, look at the torque that $80 WTI US, which is where we are today, gives them. They basically say, hey, look, so as soon as we go from 60 to 80 by 2024, so by end of 24, we're able to achieve that net debt target, no issues. So that's that green line. Let's see if I'm showing it properly here. Oh, you can't see it, yeah. So when I point the viewers can see it, but you can see that kind of trajectory from end of year to date 2023 and basically going to end of 2024. They have no issues paying down the debt to their net debt target of 600 million. And then if oil is over 100 US WTI, which is not where we are today, they can achieve it by the end of this year. So they will be paying, or they're suggesting that it's achievable in their mind to bring that from current levels, which is maybe 1.1 billion, and we will see in this quarter report what how much debt they reduced. But they're basically telling you, hey, by the end of the year we can achieve our net debt target. So that's really great to see. And here's I think the most powerful slide that MEG Energy has on their presentation for investors. This tells you exactly what they did, what they're doing, and what they're going to be doing. So for me, it's a really important slide. So you can see they have 4 stages, and they're basically saying, look, we have a strategy when it comes to free cash flow allocation. We have debt reduction, and we're buying back shares. When they were above $1.7 billion in debt, they're saying 100% of it going to debt, no question. So whenever I hear people saying, hey, how come MEG is not paying dividends? Well, this was never part of their strategy. They told you they're not going to be doing this. So if you want to be collecting dividends, you can't be expecting this if their debt is at over $1.7 billion. So, okay, fine. So they achieved that. Oh, sorry, guys, I'm a little congested. Okay, so stage 2, they go from 1.7 billion to 1.2. And they say, okay, sounds good. We're on the right path. Debt reduction 75%, share buybacks 25%. And that's why you've been seeing with Burnsco posting all those share buybacks numbers, right? Where they're buying back shares. So clearly that's been happening. Stage 3, that's where they're at right now. And you can see they transition to 50-50 net debt to, so net debt from 1.2 billion towards 600 million, which was the target. And they told us that based on the price structure, let's say if they're like at 60 WTI, it's very difficult for them to pay down the debt. They told us that in this trajectory right there. You can see it, right? So they're not achieving that. So they're almost like sustaining their business, but they're not paying the debt down. They're maintaining it, but they're kind of breaking even. So that's the 60 WTI. That's in my view. That's kind of, I'm not speaking for MEG right now. I'm speaking on my behalf, like what I understand from those slides. And please send me a message if you feel like it's incorrect. But anyway, so from 1.2 billion to 600 million, they're saying 50-50. So 50%, we're going to reduce that, use that free cash flow allocation, and 50% buyback shares. So that's great. And then they leave it a little bit open here, if you notice. So stage 4, net debt of 600 million. So let's say they achieve that. And as of now, we're at 80 WTI. Okay, we were not far away from 60. So we're in the landing. Like I see we have Captain Mark McFly here, and he is probably an expert in trajectories on how you land. So here's the type of landing here between 2024, end of 2024, and 2023. So because we were like at 67, I think, WTI, and last quarter we had like a higher differential, and soon we will be seeing their tornado chart for their sensitivities for WCS differentials and the torque they have, let's say, on the OPEX. So I think it's going to be very useful for you guys. This tells me that basically they're in between. They're not really like achieving 2024, end of 2024, paying the debt reduction target right now, as of now, but maybe they're like somewhere in between there. So maybe they're going to achieve that, 600 million debt, maybe like mid, I don't know, 2025 or maybe early 2025. But if we sustain here 80 and we go over 80, like if we go to 90 and 100, we go like that trajectory goes back to that 2023, 2024 timeframe, at which point they're telling us the following. We're telling us, look, as soon as we achieve net debt of 600 million, 0% goes to debt. Like we sustain the debt on the books, we go 100% into buying back shares, and then they say we'll consider a base dividend, further debt reduction, share buybacks, and production growth. Fascinating, because they're telling you we're going to be doing zero debt reduction, 100% buybacks, but then they keep it very open. They have this disclosure here. So the question is that I guess what they're telling us is that, hey, when we get there, we will talk about this, right? Which makes sense. So here you see also there, and I think I was right about how I read the chart. So 2025 plus, you have that basically sustained here at the same levels. Year end 2024 at $80 WTI, and year end 2023 $100 WTI, which is not where we're at. So that tells you they're achieving that by 2024 year end, and at which point they're going to be distributing this 100%, share buybacks, but maybe base dividend, and maybe further debt reduction if they feel like it, or maybe share buybacks and production growth. Yeah, so here they basically use the adjusted fund flows allocation. And by the way, if you confuse on Twitter Spaces, what am I talking about? I'm streaming live MEG corporate presentation. I'm doing due diligence today on MEG Energy, and I'm going to be showing their financials for year end and what's coming up here. So I'm also running it on Twitter Spaces. So if you want to listen here, that's cool. If you want to watch the lives on Twitter, and I heard it's draining some of the batteries, so you can always watch on YouTube. I like watching YouTube videos at double the speed all the time because it's just kind of how my brain works, and I'm able to kind of quickly go over stuff. But it's up to you. So I'm kind of doing that due diligence. You know how sometimes people say, "Oh, do your own due diligence." Well, I'm literally doing my due diligence, and hopefully, kind of you guys can expand on that, and maybe other people can share kind of their work in the future. But I think it kind of helps to better understand the dynamic of this company. Okay, so 2023 adjusted funds flow allocation. So they basically told us, hey, 450 million or so going to go towards capital. We have some debt and some buybacks here. And you can see how at $80, so that's for 60. We're not there. We're not at 60. We're at 80 now. So at 80 WTI, they're saying, hey, 450 capital allocations, right? And between 450 to about $800 million Canadian debt repayment. So the expectation is for them to pay about $350 million in debt. So that's pretty good, right? Because it kind of gets them to that trajectory towards 600 million. And if they have, let's say, 1.1 billion debt right now, that gets them to, let's say, 850. So then that leaves another like 300 million there. So towards 2024, which is basically what they've been telling us. And obviously share buybacks. And how many shares they're going to buy back? They're basically telling us they're going to buy maybe like 200 to 300 million dollars worth of share buybacks. So that's pretty good. But look how aggressive like the free cash flow becomes at $100 WTI, right? So capital 450 doesn't change really. So they're basically telling you, hey, we're not changing our capital program if we go over 100. So they're not going to be chasing that production. But they're telling you, boom, debt repayment, significant, right? So going from, let's say, what is that, $450 million to close to 1.2 billion. So they're basically like getting to the target of 600 million debt. And then the share buybacks are telling you, hey, we're going from $1.1 billion towards like 1.7, 1.8. So significant $600 million towards share buybacks. That's for $100 WTI. So hopefully it kind of gives you guys some sensitivities here. And another good thing that they do here on the slide, they give you the free cash flow yield in Canadian dollars, right? So look at the sensitivity. Often we'll go to Shabam's spreadsheets, and I love Shabam. Shabam, if you're here, please join me, send me a message. Would love to hear your input. But it's $60 WTI, and I think like based on my due diligence here, that as I've been going through that presentation, that's exactly where they're breaking even. They're telling us that because they're saying, look, at $60 WTI, we're making like 2% free cash flow yield. 2%. That's what we're getting. And we were not far away from that. At $80 WTI, 15%, so 1.5 free cash flow yield. $700 million. So not too bad. At $100 WTI, the yielding 25% free cash flow yield. So and then they basically told us in that slide how that free cash flow is allocated, which is great, right? So hopefully, kind of, I hope it adds a lot of value to you guys, so we don't have to speculate in the future. And if you kind of give me thumbs up, if you like what you're seeing, maybe we can do some more companies and kind of continuing advancing this knowledge in our community. And again, I'm running this on Twitter Spaces right now. I'm also running it live on Twitter Live and YouTube, so you can always rewatch it. This is due diligence for MEG Energy on my behalf. I'm not currently a shareholder, so no conflict of interest. I'm just sharing this information for the community, and it's my personal views based on their public presentation. No confidential information is being disclosed here. So thank you so much. All right, so WCS differentials, guys, look, this is brilliant. This is brilliant. So this slide was made, I think it was made like maybe end of 2022. But look at what they're saying to us. They're saying WCS differential significantly above average and poised to tighten. And that's exactly what happened. That's exactly what happened. Actually, I think their expectation is that the differential is going to be not $15. Based on Q1, they expected the differential to be still at $20. But their trajectory here says, hey, that's what we're forecasting. WTI to WCS differential, that's our forecast that by Q4, we'll get to $10. So they're thinking, MEG Energy thinks that by Q4 2023, the differential narrows in line with tightening global supply-demand balance for heavy crude. That's what they're saying here. And yeah, right now we're at $15. And when they made this presentation, I guess we were at $30. So they're like, hey, this doesn't look normal, right? So the average is about 15, and I think that's where we're at today, because today as we speak, we're at $80 WTI and roughly 65 WCS. Each dollar per barrel differential tightening increases estimated adjusted fund flows for MEG Energy by $45 million. Every $1. We saw a jump overnight based on Saudi announcement for production cuts. And $1 is $45 million additional to their adjusted funds flow. This jumped like by $5. So think about the torque. So 5 times 4, what is that? Like $200 million. So now they go from a structure of getting that additional adjusted funds flow of over $200 million just because of that impact on oil price. And look at their targets. Look what it means for the debt reduction targets. They're telling you, hey, we're at like $1.1 billion. We're trying to go to 500 million. And guess what? You just got additional 200 million kind of. Obviously, it's not precisely that number, but you kind of closer to that number versus what you were when the oil prices for WTI were at 67. And I think that's one big misunderstanding, like in the broader Twitter community, maybe not our community, but is that, hey, oil prices collapsed from like 120 something from last year towards like 70, 80. So everything is bearish. What this company just told you is that the free cash flow yield at $60 WTI, which is about 45 WCS, is 2%. They're doing like, okay, they're not like, the company is not going under it. Like, they're yielding 2%. And so the thesis, I think, for MEG here is like, are you ever going to be 45 WCS and under? So you don't like, and obviously we're not there. We're like $20 away from that and potentially going higher here. So that's really interesting. So what are they telling us on supply demand factors to improve into 2023? And this is this company really communicating to their shareholders in this presentation, saying, okay, that's what we're thinking. Okay. So I think this is really important because we don't have to speculate. So what are they saying about demand? They're saying easing China COVID restrictions. Okay. U.S. heavy crude refining capacity returns to typical levels. Normalized refinery crack spreads incentivizes heavy crude processing. All right. And start of purchasing to refill SPR. Start of purchases to refill SPR. So MEG assumes here that the SPR could be refilled with heavies. And we saw today, and I posted it also on Twitter. Maybe I can share this right now in the Nest. on Twitter Spaces. So what I'm sharing here is that the U.S. On highway diesel fuel prices, you can see in 2021 to 2022 there was significant rise in the fuel prices, and so the United States government back then was trying to fight the inflation, and you can see how on diesel, and gasoline did not do that, but diesel went from like $3 per gallon to like roughly $6, right? So like double. And so the question was, well, why the heavy sour crude was drained from the SPR? And somebody very influential on Twitter asked that question, and I think I had the answer. I think I had the answer because with API 30 to 50 oils, you cannot reduce the diesel fuel prices because diesel is a heavier molecule, right? And so they had to drain that heavier molecule to process diesel, and therefore you saw a price decline back to that $4 level, that $4 per gallon level, to deal with the inflation associated with diesel fuel prices. And so also the majority, I think, of SPR is sour heavy. So when you drain 50%, the partitioning just correlates, right? So we were at 740, now we're like 370, draining another 20 million. So that makes sense. But what's really important here is that MEG is telling you, hey, we think that there will be a start to refill the SPR. So that's interesting. So maybe at the end of the year. When it comes to supply, reduced US SPR releases, we've been seeing that, so no doubt about that. OPEC production cuts. This is not from yesterday. This is from like 3 months ago. MEG Energy here tells us that on the supply issues, they expect OPEC production cuts, which is exactly what happened last couple of weeks. Sanctions impact Russian supply. Sanctions impact Russian supply. Russia just cut 500,000 barrels per day, or communicated that they're going to be doing that. The communication here in the slide is that the sanctions are impacting the Russian supply. So this is fascinating to me. Increased export capacity with TMX completion increases competition for heavy Canadian crude. Makes sense. All right, so right now, I've been doing this for some time, so maybe I want to share right now. I'll unshare this slide. So thank you again for listening to me. And again, if you like this and you support me, I have this book. It's on Amazon. It's called Apollo Autism. I'm very proud of it. This is kind of to advance happiness in families, and maybe it helped me like big time even writing this book and with my patients and the way I can invest in the market. So if you want to support me, Apollo Autism on Amazon, and you can read about me here at the back, right there, about what I do and who I am. So yeah, just very proud of that. Okay, so right now I'll share. I'll share another screen. So I'm streaming live on YouTube and Twitter. So let's see, sharing the screen. And this is part of my due diligence on MEG Energy. So hopefully it kind of helps you guys. Okay, so let's look at the corporate report to shareholders now for management. Discussion and analysis and annual financial statements. I think we can find a lot of value in that. Okay, so highlights include, okay, so basically what they're telling us here is that record annual bitumen production of 95,000 barrels per day in low steam-to-oil ratio of 2.36. But the fourth quarter average bitumen production was 110,805 barrels per day. So here's an interesting kind of observation. The annual is 95, Q4 is 110. You go from SOR 2.36 to 2.22. And now what really benefits them as well is the low natural gas prices, because when I was showing you this video on SAGD, that steam is being generated by burning natural gas, right? So very, very interesting dynamic here. On the adjusted funds flow, $1.9 billion, or $6.26 per share, or 1.8 billion funds flow from operating activities. Free cash flow of 1.8 billion after 376 million of capital expenditures. And I think this year they said it's going to be like 450. Debt repayment of $1 billion, approximately 1.3 billion. Net debt declined to $1 billion US by the end of the year. So that's kind of what they're saying. So we're already at $1 billion, so we have about 400 million to cut. So that's pretty good. Now, one thing I wanted to share about this presentation, I think it's kind of interesting here on the capital expenditure. So they're basically saying again 450 million right there. So that's their guidance. They're going to produce 100 to 105 barrels per day, 100,000 to 105,000 barrels per day is part of their guidance and annual average. So we're going to be seeing in Q1 whether they're over 100,000 barrels per day because they're providing us with this guidance. And again, look how powerful this is. Non-energy operating cost, $4.75 to $5 per barrel, right? And that kind of puts some things in perspective when it comes to like the current, increase in WTI, like overnight $5, boom, right? G&A expense, so G&A includes like salaries and I guess rental, like their building, whatever, like pens, pencils, like desk, I don't know. So just under $2 per barrel. Think about this, under $2 per barrel. That's like very low operational kind of expenditure. So maybe like you have about $5 here, non-energy operating cost. You have maybe like, they share those numbers, 450 million for that capital expenditure program. So you could divide that and by the amount of barrels and kind of come up with that number essentially, right? So that's pretty cool. Okay, so this is for me. This is one of the most powerful shares MEG Energy has in their energy corporate shareholder, basically sensitivity slides. So I think it's so important. And if you just understand this, that's it. You understand all of those producers because this is really the tornado graph for sensitivities on the adjusted funds flow. And what this basically tells us is that the production is entirely comprised of crude oil, and adjusted funds flow is highly correlated with the crude oil benchmark prices. Okay, so if you bullish oil, you bullish this company. If you bearish oil, you probably bearish this company. So this table provides an annual sensitivity estimate for the most significant market variables. You don't have to guess. They're telling you that their business model is sensitive to those variables and how it's sensitive to those variables. So for example, we had a space when we talked about eco gas prices. Look at this. So 50 cents movement impacts the adjusted funds flow by about $2 million. This is nothing, right? So this is not very important. But let's start from the beginning. WCS differential, it's the most kind of sensitive, torquey, I would say, parameter that MEG's saying here that gives them that kind of sensitivity on the adjusted funds flow. They say that every dollar, right, every dollar, US dollar per barrel allows adjusted funds flow sensitivity of $45 million. So to keep it in context, if we now differential goes down by $10, this is $450 million. This is basically going from 1 billion in debt to 550. The debt target debt is 600. So that's how sensitive this is. So if tomorrow President Biden says, okay, we're going to refill the SPR and we want sour heavy because we want to secure diesel, whatever, jet fuel type of kind of molecules in the future, security, blah blah blah. And we saw that the prices, as you can see in the nest, the prices did not decline for diesel fuel prices. So for those distillates, they did not decline to previous levels that we've seen in early 2021, in May 2021. May 2021, the price was roughly $3 per gallon. Then it went by, I would say June 2022, it went by 100% to $6. Since then, it's been declining. So the strategy has been working. We don't have to guess why the heavy sour was drained. We see that in the price and the impact of the price. But think about this, what they're telling us. WCS differential, right? Because they produce the heavy molecules, $45 million. WTI, $1, $28 million. So WTI movement. So guess what happened now? We had big move in WTI to $80, right? And our differential for WCS is narrowing. So it went from $30 to $15. So then when we go, let's say on Twitter, let's say in where we're on like April now, so February, March, people complaining, people like, oh my God, what's going on with MEG Energy? What's happening? Why is the price dropping from $19 to 17? Why is it going back to 19? Why is it going to 20? Why is it going to 23? Why is it going back? Well, this is why. Because of that sensitivity to the adjusted fund flow. Because every movement in that $1, this is $28 million of adjusted fund flow sensitivity. Every $5, right? It's over $120 million, right? And they're basically telling you, hey, like we need that cash to basically bring the target debt down. And we're committed like at 50-50 level to buy back shares and paying down debt. That's where I think there's like stage 3 right now. So that's what basically telling us. And so I hope this presentation allows you a little bit more, I don't know how to frame it, like a little bit more comfort that there are actual numbers behind those sensitivities, and there's like actual reasonable explanation to why it's happening. So yeah, okay, so let's see other sensitivities. So we covered WCS is the most important one. It gives you the most adjusted funds flow sensitivity. WTI on the US dollar per barrel, again, $28 million. Man, if WTI goes to 85 and WCS goes to 70, what basically just happened is that MEG basically has another like 200 million or so, right, in that where they can accelerate their debt reduction and buy even more shares. And and what's that number? So it's basically $100 million, let's say, from that equation. $100 million, $20 per share. Let's say, what is that? So $100 million, so 5 million shares. Yeah, so 5 million shares could be bought back. So I'm just doing this kind of quick calculation in my head. Okay, sensitivity to condensates. And again, if you understand this, you understand other companies, right? You understand other companies in the space. Condensate sensitivity. So condensate is being used to dilute the oil so it can flow. Okay, so those will be kind of the hexanes, pentanes mixtures. That we often talk about, the liquids that come from the Montney. Also called the diluent, right? Condensate, diluent, C5, C6 mixture. That's all basically the same words. So what they're saying here is that move at that price impacts MEG Energy for every $1 plus minus US per barrel. It's about $14 million Canadian on the adjusted funds flow sensitivity. So if all of a sudden the prices for pentane or hexane double, that kind of tells you the impact they're going to have because they transport the product using more dilutive components. Now, why are they doing that? So the question could be, why are you just not transporting bitumen? Well, it's too viscous. So imagine like you put honey in a pipe. It cannot just flow by itself. So you have to dilute it with something that is less viscous so it can flow more easily. And that's basically what this exercise is. Okay, so sensitivity to bitumen production. So very often in our community, people will say, oh, oil production is down 1,000 barrels per day. Well, guess what? The sensitivity for the 1,000 barrels per day for MEG Energy is only $13 million in adjusted funds flow. Yeah. So if we move $1 on WCS on differential, we get $45 million. You can produce 1,000 barrels less, and you still net adjusted funds flow positive by $30 million. So that's your sensitivity. That's why it's important. Exchange rate plays an important role here. So every movement in 0.01 dollars is about $9 million. So exchange rate, very, very important here. So maybe that's why we've been seeing some sensitivity here. And non-energy OPEX, at 25 cents per barrel is about $6 million Canadian. And eco prices, again, this is the least important variable on the adjusted funds flow sensitivity. So here we are. Okay, so let's see what else I wanted to share. So hopefully, okay, let's see if there's any other tables. So I think that's about it. So I spent quite a long time here, about close to an hour on. Okay, just stop sharing here on YouTube and Twitter. So hopefully, can I give you a little bit of insight on the concept of due diligence, what it means to me to do due diligence. You know how sometimes you go and people say, "Hey, do your own due diligence." So for me, it's really like to dive into the numbers to really understand production and understand kind of their sensitivity to different prices and all that. One thing that I remember that I wanted to share, and I will do this right away because I think it's quite important. So just bear with me here for a second. Yeah, so maybe I can do it next time. But the one thing I wanted to share is basically to go over their balance sheet and just like really speak about what the balance sheet is like. But now I'm kind of lost in this limbo between between my windows here. Yeah, kind of new to that, but whatever. All right. All right, I'll just close this. Here I am. All right, so I'll open this quickly here. Maybe I'll spend a little bit more time on that. So I'm just loading their quarterly investor relation financials. So for Q year end, and I'll be sharing that as well because I think it's important. And then we'll finish the space and maybe like you guys can watch it later on. Okay, here. Yeah, so that's what I wanted to share. So let's share the screen right here. Present, share screen, window. Okay, here we go. So what you see in here is basically the 2022 and 2021. So the 3 months end for bitumen production and the economics, basically the financials, I guess, and the year end. And so I really wanted to spend maybe 3 or 4 more minutes to give you some of those insights. So because that's really kind of I'll hover over the kind of the main presentation and exactly what I did in this space right here. And then I would look at the balance sheet, right? So this is the selected operational and financial information that you can see on their financial reports. And so let's go over some of those numbers. So you can see basically in Q3, in Q4, so end of the year, right? They produced 110.8 million, thousand barrels a day, not million, of course, not million. So 110,800, okay? But for the 2022 year, they produced 95. So Q4 was like a really transformational, I would say, quarter for them because they produced an additional 15,000 barrels a day or so, a little bit more than that. And they're guiding for this year, including the turnaround, that they're going to be allocating $55 million towards the turnaround they're going to be having. So when we talk about in the spaces in the future, don't be surprised that there is a small turnaround for MEG. Yeah, they're still suggesting they're going to be producing between 100,000 barrels a day to 105,000 barrels per day, which is great. But I think this kind of row gives you some insight on what's been taking place when it comes to production. They say, hey, we're declining at 15%, but we're really not declining at 15%, right? They're saying like, hey, 2021 year end, 93,000 barrels a day, end of 2022, 95, but Q4 110, and they're yielding like basically 100. They're basically suggesting 110 to 105 in 2023. So that's good. SOR 2.22, right? The 2022 SOR was 2.36, so significant cut. And you can see kind of maybe they're utilizing it slightly more steam, but they're producing way more oil. So that steam to oil ratio is being adjusted here. All right, let's see what, and I think this is like a really important number. Let's look at this number. Cash operating netback dollars per barrel. So look right here. $43.89. Cash operating netback in Q4. Now, 2021, I think the price was end of 2021, Q4 2021. I don't remember if the prices were similar or higher, but it kind of gives you a little bit kind of sensitivity here, relative performance to the prices. But look, 2022 and overall, the netback was very strong, right? Because 2022, we had this war from Russia on Ukraine, and we saw hugely elevated oil prices from basically February, right? February, March, $120, $110. So that's kind of dare to dream scenario, right? For MEG. Cash operating netback, $62. Bang, $62. Where in 2021 it was $33. So about half. So when you saw the tornado chart for sensitivities, you can kind of see how that comes into the picture, right? So that's pretty cool. And you can see other spend. So G&A spend, look at this number, $1.62 in Q4, $1.78, right? So when people talk about, hey, that CEO is getting paid too much, or they're paying their employees, like look at those numbers. That's $2 per barrel, right? So it's not very sensitive. What's sensitive to the price of to MEG Energy performance is really WCS differentials that told us that. So and WTI prices, and maybe some condi prices as well. So that's really good. Revenues, $1.4 billion in revenues for Q4 last year. So we're going to be seeing what they're going to be reporting. I think, and I shared this in the past, and it's my personal view, that because we've seen WCS somewhat flat, and I know it's been a very different slope what happened between Q4 to Q1, because we've been kind of declining from downwards, I guess, in Q4, and then we were kind of bottomed in December and took off towards basically this quarter WCS. But net, I think WCS prices were very similar. One could argue they were like somewhere between $55 to, I would say, maybe $58. So one should expect similar value, I think. So we will see. Like if you if you see a similar number, I think for Q1, don't be surprised. At least that's my personal view, that this number could be very similar, with very similar kind of financials here that's been shared. Maybe not the production so high. Maybe production could be lower, but nevertheless, I think they could have a good quarter here. So, and again, free cash flow, $295 million for the quarter. Look at the free cash flow, guys. Look at the free cash flow for 2022. $1.55 billion free cash flow. Unbelievable. In 2021, that number was $495 million. That's like 3 times. So that's when they showed us this tornado chart with WCS differentials and WTI prices. And we had obviously kind of in early 22, we have both just like going crazy, right? And then towards Q4, we saw the wider differentials between WCS, WTI, and oil prices declining. But really, this really speaks to the torque, right? So I think it's really important to understand, for a company like this that trades at $6.6 billion market cap, has roughly $1 billion debt. In 2022, they generate $1.5 billion of free cash flow. Unbelievable. Revenue, $6 billion, $6.1 billion of revenue. Basically, that's one time. That's one time market cap, right? Or whatever it is, 1.2, 1.3 times. So really, really great to see that. And again, $1.89 billion debt at the end of 2021. $1 billion net debt US 2022. So that tells you that a lot of that free cash flow really went to paying down that debt, just like they said they would, and they did that. So now the goal is 600 million, right? So that we're in that phase. So hopefully this space was helpful and provides lots of value to all of you guys. I think I will stop. I will end my broadcast on Twitter, Twitter Live and YouTube Live, and then maybe I'll open the space here for just some conversation if you guys want to, and hopefully it was somewhat helpful to all of you. So thanks everyone for listening to me, and I'll continue with the Twitter space, so maybe we can bring some guests for some input. But yeah, thank you so much for listening to me.